What if saving money is secretly keeping you poor? I know how that sounds. You've been told your whole life that saving is the responsible thing to do, that it's the safe choice, the smart choice. But what if the exact habit that makes you feel financially responsible is the same habit that's quietly keeping you stuck? Here's what I mean. Two people can save the exact same amount of money, the exact same way, for the exact same number of years, and one of them ends up with almost double what the other one has. Same income, same discipline, same number of years, nearly double the result. By the end of this video, you'll know exactly why that happens and which one of these two people you currently are. If you've ever felt like you're doing everything right with money and still not getting ahead, stay with me for the next few minutes and hit subscribe now, because this channel exists to show you the parts of money nobody explains properly. And this one might be the most important video you watch all year. Here's the real reason this happens, and it has nothing to do with intelligence or income. Your brain is choosing certainty over wealth. Humans are wired to overvalue certainty. Your brain would rather earn almost nothing than risk temporarily losing something, even a small amount. Behavioral economists call this loss aversion, and it's one of the biggest, quietest reasons people stay savers for decades without ever crossing over into investing. It's not laziness. It's not a lack of financial knowledge. It's a brain doing exactly the job it evolved to do: protect you from loss, even when playing it safe is actually the more expensive decision in the long run. Think about how this shows up in everyday life. You'll drive 10 minutes out of your way to save $5 on gas, but you won't spend 10 minutes learning something that could add tens of thousands of dollars to your future. The brain isn't measuring the actual size of the outcome. It's measuring how the decision feels right now. Let me introduce you to two people, Jake and Marcus. Same age, both 30, same starting point. Both have $20,000 saved. Both are able to set aside $500 a month going forward. Same income, same discipline. If you looked at their bank statements side by side, on day one, you wouldn't be able to tell them apart. Jake does what feels like the responsible thing. Every dollar goes into his savings account. He doesn't touch the market. He sleeps easily because his number only ever moves in one direction. Every time he checks his balance, it's a little higher than last month, and that feels like winning. Marcus does something slightly different. He also protects himself. He keeps an emergency fund untouched, just like Jake. But the rest of his money he puts to work. Invested. Allowed to grow. Allowed to fluctuate. Some weeks, he checks his account, and the number is actually lower than before. That used to bother him. It doesn't anymore. We're going to come back to exactly what happens to both of them. But first, you need to understand the one idea that explains the entire gap. The goal was never to move your money somewhere scarier. The goal is to give every dollar a different job. The first dollars you earn become your bodyguard. That's the emergency fund. It protects you, and that was never supposed to grow much. Its entire job is to just be there, boring, and available the day you need it. The next dollars become your employees. That's the investing. Their job isn't to protect you. Their job is to work for you every day, whether you're watching or not. You don't check in on an employee every hour to see if they're doing their job. You hired them, you trust the process, and you check the results periodically. Bodyguards protect you. Employees make you richer. Most people only ever hire the bodyguard and then spend years wondering why the money never seems to multiply. Here's a version of this that stings a little more. Imagine someone who agrees with everything so far, but decides to wait 5 years before actually starting, just to feel more ready. Those 5 years don't just delay the outcome. They quietly remove the 5 years where compounding would have worked the hardest, because growth builds on top of itself. Earliest gains first. Waiting doesn't pause the cost. It just makes it invisible. So here's the question. 15 years pass. Same effort, same monthly amount, not a single missed month for either of them. Who do you think ends up richer? And by how much? Pause on that for a second, because most people get this wrong. They assume the gap is small. It's not even close. Jake's $20,000, plus everything he added along the way, sitting the whole time at 1% interest, grows to somewhere around $120,000. That's not a bad number. Jake did everything he was ever told to do. He should feel good about that. Marcus. Same starting point, same monthly amount, same 15 years. Invested instead of parked at an average return of around 8%, ends up around $235,000. Same discipline, same money going in every single month, nearly double the outcome. Sit with that gap for a second. It's not 10% more. It's not even 50% more. It's almost double, from two people who, on paper, did the exact same thing every single month for 15 years. The only difference was never how hard either of them worked. It was where the dollars were allowed to go. Now here's what's probably sitting in your head right now. What happens when the market crashes? Isn't that exactly the risk Jake avoided? That's exactly why the bodyguard comes first. Before a single dollar goes toward growth, the money protecting you from life's surprises should never be the same money that's out there fluctuating. Keep them separate. And a crash stops being a threat to your stability. It just becomes noise that Marcus's investments quietly ride out because he was never depending on that specific money next week anyway. Marcus also never waited for the right time to start. He didn't try to predict the perfect month. He just started with whatever he had and kept going regardless of what the headlines said that week. There were probably a few months where his account went backward. Over 15 years, none of those individual months mattered nearly as much as the simple fact that he never stopped. Picture this. You walk into your favorite store, and everything is suddenly 30% off. What do? Most people buy more. You feel like you're getting a deal. But when the stock market goes on sale, in exactly the same way, prices dropping, things becoming cheaper to own, most people don't lean in, they run. Why does the same discount feel like an opportunity in one place and a disaster in the other? Because the price tag is attached to fear instead of shoes. Nobody panics in the shoe aisle. Everybody panics in their brokerage app. Same math, completely different reaction. The difference between people who quietly stay stuck for decades and people who quietly build real wealth usually isn't income. It's not luck either, no matter how much it looks that way from the outside. It's the moment they stop treating every dollar like something fragile that needs protecting forever, and start giving some of those dollars permission to grow. Jake isn't foolish for the choice he made. He did what felt responsible, and in a world where nobody explained the difference between protecting money and growing it, that choice made complete sense. Most people are exactly where Jake is right now, and they don't even know it, because the account balance still goes up every year. It just doesn't tell you what it could have been. That's the quiet part of this whole thing. Nobody gets a notification telling them how much they left on the table. There's no alert that says, you could have had 200,000 instead of 120. The number just sits there, looking perfectly fine, while a completely different version of it was always possible. If you're sitting on savings right now and none of it has a growth job yet, that doesn't mean you made the wrong decisions. It simply means no one ever showed you that money has more than one job. Some dollars are supposed to protect your life. Others are supposed to build your future. And now you know the difference. The next time you look at your bank balance, you probably won't just ask, how much money do I have? You'll ask a better question. How much of my money is actually working for me? Because that one question can quietly change your financial life for decades. And if this video helped you finally understand why Marcus ended up in a completely different place than Jake, even though they earned the same money and made the same monthly effort, then you've already taken the first step most people never do. If it gave you a little more clarity, a better financial decision, or simply changed the way you'll look at money from now on, consider subscribing, because that's exactly what this channel is about, cutting through financial noise, explaining the psychology behind money, and helping you make smarter decisions without making finance feel complicated. Thanks for watching.